Now, before we continue with our discussion, let's take a quick look at another viewer's question we received. This one comes from Kirsty in Boksburg. She asks, my brother and I recently taken over my father's company and brought in my cousin as a key account manager. What type of insurance should we consider and how should it be structured? Well, certainly something that we planned on talking about in the second half, and that's key person assurance. This fits nicely into it, Raylan. Perhaps you want to pick up on that question.
Yes, key person, for example, one thing needs to be really importantly noted is that in terms of the Estate Duty Act, there are basically 4 criteria that needs to be reached in terms of a key person policy so that it is not in a position where it becomes estate dutiable. If any of these are actually contravened, you need to be in a position where you're upselling the policy, meaning increasing the value of the policy so that you can be able to pay estate duty on the proceeds. Now, first thing is that a person can never pay their own premium. The second thing is that a person cannot take out the policy at their own request as such. The third thing is that it cannot be a company-owned or family-owned company, which is quite important in this question. And the last thing is that nobody in terms of your family, dependents, or anybody like that can actually receive any kind of proceeds from the policy as such. So based on this question now, to come back to the original question, what needs to be considered here is that first of all, it's a family business. Originally, the father was the owner in the business, which means that he probably was 100% owner, and in that position, it was a family company. They have now taken over that business. The brother and sister, for example, have taken over. So now it is still continuing to be a family company. And family companies are always in a position where they don't get the exemption for estate duty. They have to pay estate duty on the proceeds. And the reason for that is that the money is being paid into the company, and the company effectively is owned by the family, which means that it's enriching the family. So that's where the problem comes in there. So what I would really suggest, first of all, is to consider looking at key person insurance between the brother and sister, because that is quite important if they are running the business. The next thing they need to consider is what we discussed last time in terms of buy and sell agreements, because if they own the business 50-50, for example, by having a policy which they own on each other's lives, they're in a position where they at least are be able to get the amount paid out to buy the shares of the other person. And again, in terms of buy and sell, family company doesn't come into play. But for a key person, it does come into play, and that's where estate duty is charged. Then the next portion of that question is that the cousin is basically becoming a key account manager, who again is another key individual in the business. So what needs to be considered there is that the cousin is actually at the 4th degree of consanguinity. Now, the idea of that is that you want to be in a position where there's 3 degrees of your family, meaning parents, their children, or aunts and uncles and nieces and nephews. Right. All of that falls within a 3rd degree. Going to cousins, it falls out of that, and that cousin wouldn't be regarded as a family person or part of that family business. So his portion of his key man policy would actually not have estate duty on it. So in terms of being able to look at that from a key person perspective, it's important to understand how it's all structured. But the next thing as well, again, we can look at a preferred compensation for the key individual to retain the staff member and obviously incentivize him to be there for a longer period of time.
I mean, at the end of the day, we keep coming back to the same thing. It really comes around how we plan around these mechanisms and structures in terms of tax, whether it be income tax, whether it be estate duty, whether it be capital gains tax. Obviously, in the event here, the cousin, there's no estate duty liability. For the others, there is an estate duty liability. But now that liability still remains with the company through that policy, doesn't it?
Correct. Shaun, what's going to happen is that in the event of that policy paying out, the executor of that deceased estate is going to say to the company, is there estate duty payable here? And in which case, in our example, there would be, pay up. And the company is going to have the liquidity to be able to meet that estate duty bill pretty much immediately. Sure. So it's in their best interests to make sure that everything is correctly structured. And just on that note, Raylan mentioned something quite interesting in terms of family company. We have to consider, was that business ever a family company? And so often when we sit with clients and we look at these types of structures, we find that businesses that were once a family company that are no longer a family company, that question never really gets asked. So in relation to that deceased person, if that business was ever a family company, we need to consider the estate duty.
I mean, taking a look at the business landscape in South Africa, surely most of the companies are going to fall into that family company definition.
Definitely.
A large amount of them. I mean, we really look at 50% ownership between 3 degrees of a family company. So, I mean, that can be quite vast. I mean, you've got an aunt and an uncle and a brother or an in-law or something like that actually in the business. Immediately that becomes a family company. So it needs to be considered. And the next thing is also to consider what Michelle has already said, is that if it is a family company ever, the estate duty will always be liable through that plan as such, and it will always be regarded as a family company. The only way to break that is to be in a position where the company physically lists on a stock exchange. By doing that, you're in a position where it's now a listed company, and that actually falls away, and it's no longer called a family company.
Takes it out of it.
Yes.
Okay. I mean, in terms of that, I mean, we've spoken about estate duty, and we in previous shows spoke about how potentially capital gains tax will pick up from estate duty if or when it falls away, which might be an eventuality. Where's the capital gains tax coming in for a key person assurance policy such as this?
Shaun, fortunately, in terms of the 8th schedule, capital gains tax is actually specifically excluded in these circumstances. So any policy on your life is going to be paid out to the original beneficial owner. You're not going to have capital gains tax. So in our circumstances, company is the owner, life assured passes away, and proceeds pay out to company. You don't have a capital gains tax situation. But it even goes one step further to say that if the policy, for example, the key man or the key person, to be politically correct, leaves the business, then you're going to have a situation where possibly you're going to cede that policy across to that person because you have no use for that policy anymore. Perhaps at that point in time, that person is uninsurable, they've got high blood pressure, had a heart attack, whatever the case may be. That cover can be very, very valuable in their personal estates. But now it's not paying out to the original beneficial owner. The Act actually specifically excludes that from CGT as well.
Okay.
So it takes it even a step further to say that if it was a key man policy, if it was conforming, you're not going to have a CGT liability.
And that's important to note. It had to be a correctly conforming policy in order to get away with the CGT.
Sure.
And I find that most times nowadays key man policies or key person policies are set up as non-conforming, so this actually wouldn't apply in that situation.
But let's talk quickly, because I mean, we've got this amount that we're talking about that's going to increase the property of an estate by, but how do we actually go about calculating what that person means to the company? I mean, it's a very, very grey area.
It's $1 million question. It's an impossible question to answer because there is no generic answer. You need to go and sit down with a financial advisor and preferably your accountant, your auditor, whoever it may be that is actively involved in the running of the financial side of your business, and say, this is the nature of our business and this is the role that this person plays. Generally in the industry there's the 7 times annual salary.
Correct.
And that's such a generalization. I mean, I really think you need to take a subjective look at the nature of the business, the role of the employee, and decide what is the financial impact going to be if I lose this person.
And I mean, there's a number of things that come into it, be it replacement costs, advertising for a new person, training a new person, potential loss of profit, especially if that person was perhaps in a sales type environment.
Definitely, because very often they hold the relationship with various customers. Suddenly that person's no longer around and that customer account is moved to another company. That company loses a huge amount of financial implications. So what really needs to be considered is what is going to happen if that person is no longer there, what kind of relationship is there with the existing accounts, and from there to be able to calculate a random amount in being able to let that company be liquid while they are actually recovering, trying to get over that person's loss.
Well, once again, I mean, we've packed this half an hour full of information around the business assurance, and I think we've covered the key areas: key person, disaster management for your employees or someone who's key to the business, and secondly, in terms of trying to retain them, it seems preferred compensation is the route that most people are favouring at this stage. Michelle, Raylan, thanks so much for your time tonight. It's really been a great discussion. I think we've got through a lot. Before we say goodbye, let's take a quick look at our weekly viewers' tips. This week, of course, our tips relate to business assurance.
Most businesses have at least one person who is largely responsible for its success. So who are these people in your business? Identify them and insure them. Because if they die or become disabled, your business could be severely affected. Correctly structured key person policies are free of estate duty, but this exemption only applies if the insured key person never paid the premium on their own policy, never set up the policy at their own request, the insured key person's family, dependents, or estate never receive any part of the policy proceeds, and the company was never a family company of the key person. In terms of Section 11W of the Income Tax Act, Correctly structured key person and deferred compensation policy premiums can be deducted from tax, but there's always an exception to the rule. Amongst these exceptions, a conforming policy is not tax deductible while there is an outstanding loan on it or while it is being used as collateral for a loan. The tax deduction is also only allowed on the portion of the premium which is less than 10% of the employee's gross earnings and cannot be increased by more than 15% per annum. In addition to this, there must be an employer-employee relationship, and the company must be the policy owner, the sole beneficiary, and the payer on the policy. But for every tax concession, there is a price to be paid. And in the case of a conforming policy, the price is to pay full tax on the proceeds of the policy, which can be quite hefty. The one advantage for the life assured is that if they leave the company can cede all rights on the policy back to them, and if all regulations have been met, there will be no estate duty and no capital gains tax on the proceeds in the life assured's estate. I must warn you, current legislation is under scrutiny and changes will be instituted from the beginning of next year. Amongst these changes, it seems that deferred compensation policies will become redundant, so look out for this. On the other hand, non-conforming policies are the way to go. By sacrificing the small benefit of the tax deduction on your premiums, you are gaining the proceeds of the policy tax-free. In terms of estate duty, if a key person complies with the Commissioner's requirements, which have been already mentioned, it is free of estate duty, while preferred compensation policies will always form part of the life assured's estate. However, at death, if the company still owns the policy, the company must pay the estate duty. Fringe benefit tax is not payable on key person policies, but must be paid on preferred compensation plans by the employee. And CGT only comes into effect if ownership has been changed. Remember that your business relies on the key people, so allow FinLogic to tailor-make a plan which is right for you.